Picture a Wednesday morning. Around 11:15 a.m., a mid-sized credit union somewhere in suburban America. The kind of place with motivational posters about financial freedom on the walls and a candy dish full of wrapped mints that have been sitting there since the Obama administration. The carpet is that specific shade of muted teal that every financial institution seems to order from the same regional supplier. Standing at the member services desk is Eleanor. She is 71 years old. She has a sensible gray blazer on because she still dresses up for appointments the way her generation does. Under her arm is a manila envelope with her photo ID, her Medicare card, and a sticky note with her daughter's phone number written on it in her careful schoolteacher handwriting. Eleanor is here today to do something she has been meaning to do for several months. Her daughter Patricia suggested it. Patricia's accountant mentioned it. The woman from Eleanor's church who works part-time at a tax preparation franchise confirmed it was a good idea. Eleanor is here to add Patricia to her savings accounts. Eleanor believes she is doing smart, responsible, forward-thinking estate planning. Eleanor is about to make the single most legally destructive financial decision of her retirement. She does not know this. Nobody in this building is going to tell her. The member services representative, a 24-year-old named Brandon, in a clip-on tie who has been working here since last spring, is going to pull up the account on his screen, ask Eleanor for Patricia's social security number, verify a few details, and slide a signature card across the laminate desk with a cheerful explanation of where to sign and initial. Brandon is going to thank Eleanor for her membership and wish her a nice day. And in the 90 seconds it took to process that signature card, Eleanor quietly handed over legal ownership of her entire life savings to every creditor, plaintiff, divorce attorney, and tax authority that will ever have a claim against her daughter Patricia for the rest of Patricia's natural life. What actually happened at that desk, Eleanor believes she added Patricia's name to her account so Patricia can pay the electric bill if Eleanor ends up in the hospital. That is what Eleanor thinks she did. Here's what she actually did under the property law of the United States in 2026. She gave Patricia a 100% present ownership interest in every dollar in that account. Not a future interest, not a conditional interest, a present, unconditional, fully exercisable ownership, right? Effective immediately, beginning the moment the ink dried on the signature card. The account is now a joint tenancy with right of survivorship, JTWRS, in banking shorthand. Under a JTWRS account, both owners own all of the money simultaneously. The bank does not maintain a ledger tracking who deposited what. The bank does not record that 100% of those funds came from Eleanor's 38 years of teaching middle school English and her late husband Gerald's life insurance policy. The bank's system shows one thing only. Eleanor and Patricia are co-owners. Either one of them can walk in on any given morning and withdraw the entire balance. The bank has no legal obligation to notify the other owner, seek the other owner's consent, or leave so much as a voicemail. That is not a flaw in the product. That is the product. And here is the part that should stop you cold. Patricia didn't just receive the keys to Eleanor's account. Every creditor Patricia has ever had or will ever have also received those keys. Every plaintiff who sues Patricia receives those keys. The IRS, if it audits Patricia next year over income from her freelance bookkeeping work, receives those keys. Patricia's husband Carl, who is perfectly pleasant right now and coaches their son's Little League team, receives those keys the moment he files for divorce, which statistically speaking, given that the divorce rate among Americans over 50 has roughly tripled in the past 3 decades, is not an insignificant possibility. Eleanor wanted Patricia to pay her electric bill if she got sick. What Eleanor actually did was volunteer her retirement savings as collateral for every legal and financial disaster that will ever enter Patricia's life. The legal architecture nobody explained joint tenancy as a legal concept goes back centuries in English common law. It was designed for married couples and business partners who genuinely intended to share assets on equal footing. It was never conceived as a substitute for an estate plan between a retired parent and an adult child who lives in a different county and visits on holidays. But starting several decades ago, branch banking discovered that joint accounts were easy to sell to seniors anxious about probate. The pitch was simple: add your kids, avoid court, save the family hassle. Millions of seniors took the offer. The industry got new deposits. The legal consequences landed somewhere else entirely. The result, playing out in courthouses across this country on any given business day, is that hundreds of billions of dollars of senior savings currently sit in joint accounts, where the senior believes they own the money and the law has a different, far more complicated answer. Here is exactly how the law works against you once that signature card is processed. The moment Patricia's name appears on Eleanor's account, 3 things happen simultaneously in the legal background, invisible to Eleanor, who is driving home thinking she handled something important. First, the IRS may treat the addition of Patricia's name as a present interest gift. The 2026 annual gift tax exclusion sits at $19,000 per recipient. Depending on how the account is used going forward, there may be a reporting requirement under IRS Form 709 that nobody at the credit union mentioned and that nobody is going to file, which means there is now a quiet, invisible tax compliance issue embedded in the account that nobody is tracking. Second, Patricia's judgment creditors. Anyone who wins a lawsuit against Patricia can now serve a writ of garnishment on the credit union. The credit union, looking at its records, sees Patricia listed as a co-owner. The credit union freezes the account, all of it. Eleanor's money accumulated over 4 decades is now inaccessible pending a legal proceeding that Eleanor had no part in creating. Third, if Patricia ever applies for Medicaid, files for bankruptcy, or goes through a contested divorce, she is required to disclose every account on which she is an owner. Patricia must list Eleanor's accounts. And the moment it appears on that disclosure, other parties begin asking how much of it they can reach. 3 scenarios where this destroys everything. Scenario 1. The lawsuit: Patricia is 44. She drives a used Honda Civic. One morning in November, she is running 15 minutes late for work, and she rolls through a 4-way stop at a residential intersection. She strikes a vehicle driven by a 38-year-old electrician named Marcus. Marcus suffers 2 fractured vertebrae, a shoulder separation, and nerve damage that prevents him from doing overhead work, which is most of his job. Marcus's attorney files suit. The jury returns a verdict of $1.20 million. Patricia's auto insurance policy limit is $300,000. The insurance company pays its limit. A $900,000 judgment remains outstanding with no coverage behind it. Marcus's attorney does what every plaintiff's attorney in America does after a judgment: runs a comprehensive asset search. In 2026, this process is largely automated. Commercial databases aggregate banking relationships, property records, business filings, and other public information. The search returns within hours of the judgment being entered. It finds the joint account. The attorney files a writ of garnishment. The credit union receives it on a Thursday. By Friday, Eleanor's savings are frozen. Eleanor hires her own attorney to file a motion challenging the garnishment. The retainer is $4,500. The litigation takes 14 months. Eleanor's legal fees total roughly $22,000. She recovers a portion of the account. She does not recover the legal fees. The total cost of the convenience that was supposed to let Patricia pay her electric bill, over $100,000. The electric bill was $130 a month. Eleanor could have paid it herself for 64 years on what this cost her. Scenario 2. The divorced Patricia has been married to Carl for 11 years. They have 2 children. The marriage has been struggling quietly for about 3 years, in the way that married couples manage to keep struggling quietly for years before something finally breaks. In the spring of 2027, Patricia files for divorce. It is contested. There is a disagreement about custody, about the house, about Carl's business income. Carl's attorney requests full financial disclosures. Patricia is legally required to list every account on which she is a named owner. She lists the joint account with her mother. She has to. Omitting it from a financial affidavit in family court is perjury. Carl's attorney immediately flags the account. In community property states, the attorney will argue that Patricia's ownership interest in the account constitutes a marital asset subject to division. In equitable distribution states, the account's existence will be used to argue that Patricia has access to outside resources, which affects how the judge divides the marital estate and calculates spousal support. Even if Eleanor ultimately keeps her money in a strict legal sense, the existence of the account has now distorted the entire settlement. Carl walks away with a larger share of other assets to compensate for what the court perceives as Patricia's access to her mother's savings. Patricia ends up financially worse off. Patricia comes to Eleanor for help. Eleanor's money leaves through a different door. Meanwhile, Eleanor, 71 years old, retired, on a fixed income, has spent months producing bank statements for a divorce attorney she has never met, answering questions about her own savings account in a deposition, and explaining to a family court proceeding why her retirement funds should not be treated as a marital asset in her daughter's marriage. She signed a card at the credit union. That is the event that produced this outcome. Scenario 3. The tax levy: Patricia has run a small bookkeeping business as a side operation for several years. She has been somewhat casual about reporting all of the income. In 2025, with an expanded enforcement budget and better data matching tools, the IRS flags Patricia's returns for examination. The audit covers 3 years. The agency identifies $160,000 in unreported income. After back taxes, interest, and penalties, the assessment totals $81,000. Patricia enters a payment agreement. She misses 4 consecutive payments. The IRS files a notice of federal tax lien. Under federal statute, This lien attaches automatically to all property and rights to property belonging to the taxpayer wherever that property is located. No court order required. No advance notice to Eleanor. No opportunity for Eleanor to be heard before the levy is processed. The IRS issues a bank levy. The credit union has 21 days to respond. On day 22, Eleanor's account is drained. She discovers this when her debit card is declined at the pharmacy. Eleanor can file a wrongful levy claim, an administrative process through the IRS in which she bears the burden of proving with documentation that the funds were entirely hers. This process takes between 6 months and 18 months. Eleanor's money sits with the United States Treasury during that period, earning nothing. She may recover some of it. She may not recover all of it. She will spend money on professional help to navigate the process. The cost of the transaction that was supposed to provide convenience, potentially her entire retirement savings. The industry that profits from this, the collections and judgment enforcement industry in the United States, generates revenues exceeding $20 billion annually. This industry does not wait passively for debtors to pay voluntarily. It subscribes to automated database services that monitor public records, flag new judgments, identify banking relationships, and generate garnishment targets algorithmically. Joint accounts owned partly by elderly co-owners are a known and targeted category. The logic is simple. Seniors tend to have higher account balances than younger individuals. Joint ownership creates legal exposure. Automated systems find that exposure and act on it faster than most people realize is possible. The banking industry is aware of this dynamic. The banking industry continues to offer joint account upgrades as a convenience product to seniors seeking simple estate planning solutions. The reason is equally simple. The bank bears no loss when a garnishment occurs. The bank collects its fees whether the account is joint or single. The bank has no financial incentive to explain the exposure, so the bank does not explain it. Tyler doesn't tell you. Brandon doesn't tell you. The branch manager doesn't tell you. The friendly retirement planning brochure in the lobby waiting area definitely does not tell you what you should have done instead, and can still do now. The right tool for probate avoidance is a payable on death designation. A POD designation, also called a transfer on death or TOD designation on brokerage accounts, is a beneficiary instruction attached to your account. It says, this account belongs entirely to Eleanor while Eleanor is alive. Upon Eleanor's death, the balance transfers automatically to Patricia without going through probate. While Eleanor is alive, Patricia has zero ownership rights, zero access, zero ability to withdraw funds, and critically, Patricia's creditors have zero claim. Her divorce attorney has zero claim. The IRS levy related to Patricia's tax problems has zero claim. Patricia's name is not on the accounts. She is simply named as the recipient of whatever remains when Eleanor passes. POD and TOD designations accomplish exactly what seniors are trying to accomplish with joint accounts, avoiding probate, without any of the catastrophic legal exposure. You can request a beneficiary designation form at your bank tomorrow. Most institutions have the form available electronically. You fill it out, name your beneficiary, sign it, keep a copy. The entire process takes less time than setting up a joint account. There is no product to sell, which is precisely why nobody proactively offers it to you. The right tool for incapacity planning is a durable power of attorney. If your goal is to let your daughter pay your bills, if you become incapacitated, the legally correct instrument is a financial power of attorney, sometimes called a durable power of attorney for finances. This is a document drafted by an attorney that authorizes Patricia to act as your agent for financial matters with whatever specific scope you define. As your agent, Patricia can pay your bills. She can deposit checks, she can communicate with the bank on your behalf, she can do everything you wanted her to be able to do. But she is acting as your representative, not as a co-owner. The funds remain yours. Her creditors have no claim. Her marital status is irrelevant. Her tax compliance is irrelevant. A properly drafted durable power of attorney costs somewhere between $200 and $800 in most markets, depending on your state and the attorney's fee structure. That is the complete price of solving the convenience problem without the legal exposure. Compare that to the cost of a single garnishment proceeding. Your action plan this week. Step 1, stop. If you have not yet added an adult child to your account, do not do it. Whatever the reason, whatever the convenience argument, whatever a well-meaning relative suggested, do not sign that card until you have replaced the goal with the correct legal tool. Step 2, write down every account on which any name other than yours or your spouse's currently appears. Institution, balance, joint owner. This is your exposure map. This is what you bring to an estate planning attorney. Step 3, contact your bank and request a beneficiary designation form for each account. Ask specifically about POD for deposit accounts and TOD for brokerage accounts. Fill them out, keep copies. This addresses the probate concern without creating ownership exposure. Step 4, contact an estate planning attorney, not a general practice attorney, specifically an estate planning attorney, about a durable power of attorney for finances. This addresses the incapacity concern without creating ownership exposure. Step 5, have an honest conversation with your adult child. They are probably not aware that being named on your account exposes them legally as well. This is not a conversation about distrust. It is a conversation about mutual protection. Removing their name protects both of you. Step 6, if your situation involves substantial assets, multiple children, blended family considerations, or a special needs family member, invest in a comprehensive estate plan. A revocable living trust, properly drafted and funded, places your assets in a structure that is largely insulated from the creditor exposure problems of joint ownership. Total cost for a full estate plan in 2026 ranges from roughly $2,000 to $7,000 depending on complexity and geography. That is a one-time expenditure. The alternative, as we have now calculated 3 different ways, can cost you everything. The bigger picture, the joint tenancy structure embedded in American property law was not designed for a litigation environment where any automobile accident can produce a 7-figure verdict. It was not designed for a tax enforcement system capable of levying a bank account within 3 weeks of issuing a notice. It was not designed for a long-term care system where a single year in a memory care facility exceeds the median American household's annual income. It was not designed for a divorce rate among Americans over 50 that has risen dramatically over the past 3 decades. We are using legal tools built for a different era to navigate a financial and legal landscape that those tools were never equipped to handle. The mismatch produces casualties. The casualties are disproportionately seniors who saved carefully, paid their obligations, raised their families, and walked into a branch one Tuesday morning to do something they believed was responsible. Eleanor did not make a reckless decision. Eleanor made a reasonable decision based on the information available to her in that credit union lobby. The information available to her was incomplete because the people who had complete information had no financial incentive to share it. The system is not going to fix this on your behalf. The collections industry is profitable. The banking industry is profitable. The legal profession is profitable. Each of these industries is functioning exactly as designed. What you can fix is your own accounts. This week, not after the holidays, not when things settle down. This week, before the next event that nobody planned for, because there is always a next event. Pull the names, file the POD designations, sign the power of attorney, have the conversation. The vault is yours. The law gives you the tools to keep it that way. Use them before someone else uses the law against you.